And Vodafone said this morning that it had returned to growth in Germany, its biggest market, during its most recent trading quarter. The news came as the mobile and broadband giant reported an operating profit of €1.66 billion for the 6 months to the end of September, reflecting foreign currency movements and the disposal of a number of businesses in the previous year, including operations in Hungary and Ghana. Vodafone, which recently sold its Spanish business and which is seeking to merge its British operations with Three UK, also said it was on course to hit its earning targets this year. The tobacco and vaping group Imperial Brands has reported a rise in annual profits despite Germany and the UK, two of its biggest markets, suffering a contraction. The Bristol-based company, whose brands include Richmond, Embassy, Regal Signature and the vaping brand Blue, reported an adjusted pre-tax profit of £3.5 billion for the 6 months to the end of September. That was up from £3.4 billion during the previous 12 months. Well, Stefan Bomhard, the chief executive, said Imperial now had credible propositions across vape, heated tobacco and oral nicotine, and now offered consumers potentially reduced harm choices in more than 20 European markets as well as the United States. BT Group said today that the deficit in its pension scheme, the biggest private sector pension scheme in the UK, has more than halved during the last 3 years. The broadband and mobile giant said that at the end of June, its funding deficit had fallen to £3.7 billion from just under £8 billion at the end of June 2020. BT said it will continue to make annual contributions of £600 million into the scheme, which has more than 250,000 members, until the end of March 2030. And the support services and defence contractor Babcock today confirmed it is to resume dividend payments to shareholders after a 4-year break. The company, which manages Devonport Royal Dockyard in Plymouth and which oversaw integration of the UK's new aircraft carriers at Rosyth Shipyard near Edinburgh, reported an underlying operating profit of £154.4 million for the 6 months to the end of September. That was up 27% on the same period last year and reflected increased sales from its nuclear arm and work on new contracts for the Polish and French navies. Well, last night's quiet session on Wall Street was followed by a largely positive session overnight for stocks in the Asia-Pacific region. Show you those. There we are. Only the Hang Seng in Hong Kong finishing below the waterline overnight. That's been followed by largely positive trade in continental Europe this morning. All of the main indices there right now in positive territory, as you can see. Talking points today include RWE, the German energy generating utility, is ahead 1.75% in Frankfurt after its quarterly results beat expectations. Well, here in London, the FTSE 100 is off just under 0.5%. Heavyweights Shell and AstraZeneca both weighing on the index this morning. Among the leading fallers is Vodafone, mentioned them a moment ago, off 2.5% on its results. Among leading gainers is the mining and commodity trading group Glencore. Its shares up by nearly 3.25%. That's after it agreed to buy the Canadian miner Teck's steel-making coal assets for $9 billion. The Irish Support Services Group, DCC, though, is the leading FTSE gainer right now. It's ahead by nearly 8% on its third quarter results. Another gainer to mention is Informa, the publishing and events organiser. That's up by nearly 5% on a trading update. Outside the FTSE 100, Oxford Instruments is ahead by 5.25% on its results, but the industrial engineering group Vesuvius is off by some 5.5% after it reported a softening in some of its markets. On the foreign exchange markets, well, the main story continues to be weakness in the Japanese yen against the US dollar. Sterling, meanwhile, more or less unchanged against the dollar. It's off about 1/6% right now against the euro. The single currency, meanwhile, up 1/5% against the greenback. As for the oil price, well, that's traded in an exceptionally narrow range this morning. A barrel of Brent crude will currently cost you $82.64 a barrel. That's up 1/6% on the session. Well, joining me this morning, as promised, is Sanjeev Tumkar. He's Head of Equity Research at Rathbone Investment Management. Sanjeev, good to see you again this morning.
You too.
Let's start with Imperial Brands, one of the big players in the tobacco world, of course, number 4 globally. What did you make of their numbers today?
Pretty decent, actually. I think the tobacco industry has been struggling for the last 5 years with concerns about health. They're trying to combat that by developing lower harm products. So in the case of Imperial, it's things like their Blue vaping product. There's regulatory issues in the background. The US FDA wanting to basically ban flavoured vapes, such as menthol flavours. But despite that, we've had some decent figures, particularly cash flow from Imperial Brands, and that's what these tobacco companies are really noted for. It's prodigious cash flow and the ability to pay very handsome dividends.
Yeah, I was amazed looking at the UK. The collapse in volumes was really quite breathtaking.
Yes, I mean, there's the trouble with tobacco is you're fighting constant volume declines. What they have is incredible pricing power because it's obviously quite an addictive product. So very good pricing, volume declines, particularly in developed markets, which is where Imperial Brands is most exposed. It is actually benefiting from a bit of trading down, though, particularly in the US market. Its portfolio is a little bit more skewed towards value, which one would expect to do better in tougher consumer environments.
Now, another company reporting today is Babcock. I mean, a business that's been in the sort of sick bay for a while now, but it looks as though it's turned itself around.
Yes, I mean, again, really good cash flow figures from Babcock, which one couldn't always say about this company in years gone by. It obviously supplies to defence services, mainly to the UK Department of Defence, but about 40% is non-UK. It does things like pilot training, technical training, maintenance of warships and those sorts of things. So a lot of very interesting technical engineering skills. The challenge with it was always that it never quite seemed to get the pricing it needed for those, or indeed the cash flow, and it now seems to be coming through, which is good to see.
Yeah, we had the CEO on the programme fairly recently. I mean, what's also striking is that they are winning new orders from overseas at quite a rate.
Yes, absolutely. I think the one they were talking about, particularly impacting the results, was in Poland, frigate services contract. Yeah, I think it's a pretty good time for defence services in general, as we see every day on the news. Very sadly, geopolitical tensions around the world and defence spending is a priority. So if you're a trusted partner for a major Department of Defence, as they are with the UK DoD, then yeah, it's a good position to be in a sort of tougher economic conditions.
Yeah. Now, what about the jobs market figures that we saw this morning? Any surprises? I mean, they actually looked better than most people had expected.
Yeah, I think consensus was expecting the unemployment rate to tick up a bit to 4.3, and actually it was flat at 4.2. So. And also the wage growth figures were actually sort of ameliorating from very high levels, but still pretty healthy levels, and actually some very positive real growth ahead of inflation. So so far it feels like the economy is holding up maybe better than some people were fearing. I guess the big question is, to what extent will that start to slow as the impact of interest rates, particularly on people that are having to churn off fixed rate mortgages at much higher rates, what impact that will have.
Yeah, I mean, no real repercussions for the Monetary Policy Committee in the data today. I mean, it certainly probably acts against another rate hike, but it's not enough to perhaps to get them to sort of go the opposite direction yet.
I think everyone is so worried about this kind of inflation kind of chimera. They, not just the UK Monetary Policy Committee, but the Fed as well in the US, they are looking at labour data, but they're probably going to err on the side of caution before they start even thinking about cutting rates. And I think that's probably certainly into next year.
Yeah, next year's story. Sanjeev, got to leave it there. Good to see you this morning. Thank you.
Thank you.
Still to come here on Business Live, I'm going to be joined by the Chief Executive of Land Securities, the UK's biggest commercial property company. They're expecting an uptick in investment next year. Join us after this break for more.
Fly Emirates, fly better. Thank you.
Welcome back. Now, it's been a tough year for startups seeking funding, but despite that, promising ideas are still able to access capital. Barclays, an unreasonable group, an investment firm that takes stakes in growth stage businesses, are today hosting an annual event to which they've invited 25 of the most promising high growth ventures from around the world dedicated to solving global challenges. Well, joining me now, Daniel Hanna. He's Global Head of Sustainable Finance for Barclays Corporate and Investment Bank, and Daniel Epstein, founder and chief executive of Unreasonable Group. Welcome to you both. Daniel Epstein, let me start with you. What sort of businesses have you asked along today?
Yeah, thank you, Ian, for the opportunity. Today we're welcoming, as you mentioned, 25 of the entrepreneurs that we're supporting, and they're looking at everything from the future of food waste and how to prevent it to rapidly increasing our availability to renewable energy. I'm looking at how we can make new products out of pollution. Through biofermentation. So really advanced technologies at the nexus of impact, profit, and sustainability.
And you're not seeing any shortage of potential backers for these types of activity?
Specifically for companies that baked into the DNA of their profit model, they're solving a meaningful problem. No, through this partnership with Barclays, we call it Unreasonable Impact. We're supporting a portfolio of 310 ventures, and they've raised over $12 billion in financing. The markets have gotten tighter, but I think the investor appetite and interest in sustainably oriented businesses is really here to last, and we're seeing that come back.
Well, Daniel, Hannah, let me bring you in. I mean, Barclays has been involved in this programme since 2016, I think. How much do you typically provide in support for a business?
So I think we are very much focused around how we can help companies take ideas all the way up to IPOs. And there's many different ways that we do that. The Unreasonable Partnership, as you mentioned, going since 2016, has been a really critical part of doing that. But we've also committed £500 million that we're investing in early stage companies. Some of those have graduated through Unreasonable. So, for example, British innovation success story Brill Power, which really looks at how it maximizes the use of batteries and therefore reduces battery waste. Or another company, 80 Acres, which uses vertical farming to reduce water usage by 99%, 100% renewable powered. And actually, we were able to partner with them to showcase their strawberries at Wimbledon earlier this year. So I think we're very much committed to this space, and we see a huge opportunity to support the UK and internationally grow climate tech.
I imagine this is quite high-risk lending for an organisation like Barclays compared with a lot of the traditional enterprises to which you provide support.
Yeah, so I think this is early stage technologies, and so that's why we work with Unreasonable as a partnership to really help build those ventures, give them support, not really just in terms of money, but actually in terms of access to ecosystem, investors, and broader sort of networks that can really help scale their technologies. The £500 million that we invest as equity, we tend to take board seats, work very closely with those companies, and really try and understand how we can kind of help scale them and accelerate their progress. In terms of the lending that we do, it tends to be much more established projects. So, for example, we supported Moray West, which is a big wind farm off Scotland that eventually is going to power 50% of Scotland's electricity through wind. So I think it is different types of risk. We have different tools, different ways of supporting to really try and grow this opportunity.
Daniel Epstein, I mean, this is often referred to as impact investing. Do investors have to sort of take a longer investment horizon or accept lower returns?
Yeah, that's a great question, Ian. And I think there's a misconception in the market that quote unquote impact investing is concessionary. We really believe that it's not just that you can do well and do good at the same time, but that actually you can maximize financial return or alpha by focusing on solutions that are solving problems that are more valued by the market because they're harder to solve. So we've seen the inverse. We see the portfolio of companies that we are supporting outperform common venture capital and private equity statistics in terms of return profile.
And Daniel, Hannah, back to you. I gather you're taking part in COP28 in the near future. What are your expectations for the event?
Well, one thing, sorry, and apologies to interrupt, I was just going to add to what Daniel was saying. If you look at the state of venture capital and private equity, it has suffered over the last 12 months. We've seen overall volumes drop, but at the same time, the amount of capital going towards climate tech has actually increased. So if anything, we're seeing during tough times, investors are really looking at this big secular trend of decarbonisation, of the opportunity that things like circular economy presents, and actually pivoting towards that. Transactions are still happening. They are taking longer to happen, but we're still seeing a lot of investor interest. And to your question around COP, I think one of the big areas of focus is how we are going to be able to take renewables, for example, which has grown fivefold since the Paris Agreement, and triple that even further. So how we sort of scale renewables, the more established climate technologies, and then how we tackle what are called these sort of hard to abate sectors, these really difficult industries. How do we decarbonize things like steel, agriculture? And that's where this next wave of climate technology is going to be so critical to really drive that change.
OK, gentlemen, we have to leave it there. Thanks for joining me both today. Appreciate it.
Yeah, thank you.
Thank you.
Now, Britain's biggest commercial property company said today it expects to see a pickup in investment activity in the sector next year. Land Securities, whose assets include the Lakeside Shopping Centre in Thurrock and a 75% stake in the Media City complex in Salford, was reporting earnings of £198 million for the 6 months to the end of September, in line with the same period last year. But falling property valuations pushed the company to a headline pre-tax loss of £193 million for the period, which was again in line with next year. Well, joining me now, I'm pleased to say, is Mark Allen, Landsec's Chief Executive. Mark, good to see you again this morning. I mean, the key point for you here, I guess, in the period is that both rents and occupancy rates improved.
Absolutely, and I think that's something we've seen pretty consistently over the last 18 to 24 months, is that for best-in-class space, whether that's offices in the best locations in London or elsewhere, or whether it's the prime catchment dominant shopping centres, the demand for that space has continued to grow. And so occupancy has been increasing, rents have been increasing. As you said in your opening remarks, of course, this is an environment of rising rates, and to some extent that has outpaced the underlying strength of operational performance from an asset value point of view. But the underlying occupier fundamentals of our business, of our sector, remain very much robust.
I mean, you expected prices to fall during this period. They have indeed done so. Where are your expectations on pricing going forward?
Yeah, I mean, it's a difficult call. 12, 18 months ago, we certainly were of the view that the rapid rise in rates that we were seeing was likely to continue. We took the decision as a result to sell around £1.5 billion of property at values that are well ahead of where those assets would be today. So it put our business into great shape to be able to invest when we see opportunities. And I think 2024 is going to be a year when we're going to start seeing some of those opportunities. Having seen a degree of stability in interest rates, a degree of stability or falling of inflation in recent months, I think those are both welcome signals. Now, of course, there's still a long way to go. But if we see a sustained period of relative stability, then I think transaction volumes, investor interest in the sector will pick up in 2024. And we certainly would be among those expecting to find interesting opportunities.
Well, we'll come on to that in a second. But, I mean, you've also been cutting your exposure to office space here in the City of London. You've still got a lot of office space in the West End and beyond, outside London as well. What are you seeing there? Has this whole working from home phenomenon sort of withered on the vine a little?
Well, we've probably got 25,000 people working in Landsec offices across London in totality. And, as with all offices these days, everyone taps in and out with their security pass. So if we look at what's happened year on year, we know that footfall, people visiting, spending time in those offices is up 22%. Year on year. So we're definitely seeing a continued sort of return to something closer to what we would have considered normality before the pandemic. But your point about City versus West End, I mean, I think what occupiers are looking for, what employers, and more importantly, what their employees are looking for, are places that are easy to get to in terms of transport connectivity, that have lots to do in terms of amenity around and about the place. So you're not just going to be in the office. And the office itself has to have all of the right sustainability credentials. It has to have the right well-being credentials to it. It's got to be a space you want to spend time. So if you're ticking those boxes, you're doing very well. And I don't think that's necessarily a City or West End thing per se. It just means that where in the City there have been a greater proportion of single occupier large headquarters buildings, I think those are the buildings where we've started to see employers look to reduce footprint. And so vacancy is higher in the City than it is in the West End. as a result, occupancy or rental growth is stronger and more sustained in the West End. And we've moved our portfolio from being roughly 50-50 City and West End to being about 75-25 over the past 18 months in favour of the West End.
Now, what about retail? I thought your commentary this morning, you struck quite a positive note.
Yeah, I'd tell you the one really interesting number, well, obviously there are lots of interesting numbers, but one particularly interesting number about retail that was in our announcement today was that in the 6 months to September, that's the first time in 6 years where we've been renewing leases with existing occupiers in our shopping centres, and the new rents is higher than the previous one. We've been through a period of very substantial correction. So rents are now very clearly growing for the best shopping centres. And you can buy these shopping centres for around an 8% yield. So an 8% yield with growth, to us, looks a really interesting place to be investing. So we increased our stake in Bluewater. About 2 years ago, we bought out our joint venture partners, lenders, in Cardiff earlier this year. And we certainly see that as a sector that in a very targeted, selective way, I could see us investing in. But for us, it must be about finding the scarce opportunities for fantastic assets at great prices.
That's very encouraging to hear. Now, you mentioned just now you're looking for opportunities next year. Where are you looking to add to the portfolio?
So, I mean, retail, prime retail, I think certainly would be something that we would be comfortable increasing our exposure to. We have then a big development pipeline of sites, both within central London, but also in our mixed-use urban portfolio elsewhere in the UK. And we've got the opportunity to invest in bringing those projects forward. And I think the returns on those look really quite interesting as well. So it'd be a mixture of London office, retail, and our urban mixed-use portfolio.
Now, in July, you and British Land, unusual bedfellows on this occasion, you actually made some recommendations to the government on how to encourage regeneration of brownfield sites. Have you had any response yet?
I have to say, whether it's the government or the opposition, the level of engagement that we've had, I think probably more broadly than just our proposals around regeneration, I think has been really encouraging. But what our proposal in conjunction with British Land was talking about was how can we incentivise and accelerate the sustainable and sympathetic regeneration of existing brownfield sites rather than obsessively focus on planning being about building or not building on green fields. And there's a huge amount we can do to deliver more jobs, more homes, more growth through actually approaching regeneration in a much more creative way. And I think we're seeing a positive response from both the government and from the opposition. Therefore, between the two of them, whoever is the government longer term, I think are increasingly aware of and alive to the opportunities to really drive growth through brownfield regeneration.
All right, Mark, we have to leave it there. Always enlightening talking to you. We do appreciate you spending the time on a busy day. Thank you.